Welcome back to Benchmark. In our feature segment today, we speak to the Managing Director and CEO of Capital Alliance, Ajith Fernando. He gives us his views on the happenings at the Colombo Stock Exchange, the so-called expropriation bill, and what's new on the IPO front. Ajith, welcome to Benchmark, and thank you for coming to our studios to meet us. Now, look at the stock market, or the Colombo Bourse for that matter. Are you happy with what's happening on and off the floor? What's your big picture take on this?
We had an excellent run. We had almost 3 years of a bull run. So taking an occasional breather is not such a bad thing. I mean, it gives you the opportunity to look at your systems, put controls in place and things like that, and to re-look at your company and things like that. So it's not such a bad thing. I mean, I don't consider it a life and death situation. And this is a correction. I mean, this correction was long overdue. So I don't consider it such a bad thing to worry about, or take drastic action or anything like this. This was expected.
Post-budget 2012, the market shed something like 65 billion rupees. Now, does this reflect the sentiments of the investor at the end of the day?
I mean, definitely always when the market falls, that means the investors are particularly not too happy about some factor. But we must look at this 65 billion. While individually it may be a large sum of money, our market is almost 2 trillion. Or more than 2 trillion. So in that sense, 65 billion is about 3% of the market. So a market that comes down 3% is not a huge calamity. For example, we were in Hong Kong about about a month ago, and the market fell 7% in one day. So things like that do happen. I mean, there is occasional thing. Having said that, the budget also, I mean, it was a budget that consolidated what the course of action that was set out last year. So there was no new surprises, no new tax gimmicks or anything like that. But it's a good thing. It's a continuation of last year's policy. So on one side, there was nothing new that came out of the budget, which is the good thing to do. I mean, that shows continuation of policy. The bigger surprise and the bigger problem was the devaluation of the exchange rate. People did not expect a budget to do a devaluation. So that was a big shock to the market, and that affected foreign investors. And now, even though that may not have resulted in foreign investors exiting the market immediately, it gave a signal to the local investors that foreigners may try to exit. Second thing that happened with that, the interest rates went up almost 100 basis points almost the next day. Now, both these factors are very bad for the stock market. So that is what caused the market to drop. But we have to consider the fact that this is in the backdrop of a global market that was falling rapidly also. So all the factors pointed towards the market going down, and which is why it lost.
The so-called expropriation bill, or the revival of underperforming enterprises and underutilized assets, passed in Parliament recently. Surely this has serious and negative implications to the investor community. What do you think they see in this whole scenario?
Here again, there is two factors to look at. One is what is the reality of the bill, and how it is perceived. Now, the reality of the bill, if you look carefully, I am not going into individual assets, but most of the assets, or majority of the assets, actually were assets that were actually underutilized. And we must accept the fact that you can't give land to a private company on a lease for them to build a factory, and then you can't have them building a cinema on that, for example. It has to be for the purpose that they got the land. So we have to accept that fact. Now, or if they are not doing any work, that land has to come back to the government. The way it is presented, particularly this expropriation bill, the very word expropriation, drives shivers into the hearts of any foreign investor. I must be very honest, even this week we had a foreign investor who just started investing in Sri Lanka, who flew down specifically from the US to Sri Lanka just to see what the real situation was. And the words that were used by them are Venezuela. I mean, they try to see whether we are going down the road of Venezuela. So in that sense, I think we have to give much more weightage to handling the public perception of this act. I think the government, while they may have all good intentions, did not look carefully at how the public will perceive this, and did not do enough to address that issue before they passed that. I think they should have paid much more attention to how it's presented.
What about the impact on the stock market? Do you feel that the market did have an impact at the end of the day? There were two two companies, listed companies that had their shares suspended, etc., and trading suspended, both hotel developers, Hilton and Parvati Sugar. How would investors in our equity market view this, and what's next at the end of the day?
It is a big problem. When you have a listed company that's suddenly taken over by the government, it's not a pleasant experience. So I think people will start paying a lot of attention to any company that has any kind of exposure to government leased assets. And in fact, having spoken to a lot of private investors, they are concerned about going into any kind of development which includes lease assets from the government. Now, one thing must be made very clear that private assets were never part of this expropriation bill, and that must be conveyed over and over again, particularly to foreign investors, that this is not a case of nationalization, because they look at any kind of expropriation of assets as a nationalization policy, and that is the end. So we have to be very concerned about giving this message out, and that individually we can do, plus the media can do, is to give out the message that, look, whether you agree with this bill or not, it's not a nationalization policy. It is very clearly not. Regarding the listed companies, it's a big problem. I mean, you suddenly find shareholders who have a share that's worth nothing, or much less than what it was worth 2 days before. That kind of thing can never be very good for the market. So of course, you have to balance the needs of the country with the balance of needs of the investors. It's never good. I mean, there is no good way to handle such a thing.
So where do you stand on the hotly debated issue of market manipulation and insider trading? Is this just simply speculation? Where does this modus operandi take us anyway?
The debate is whether they are happening or not. I don't think there's any debate there either. I mean, it's fairly clear that, and this happens in any market. Let's not mince our words. It happens in the most advanced market. It happens in our markets. It happens in less developed markets than us also. So it's a question of has the SEC done enough to stop this? Or have they got the teeth to stop this? Now, if they say that they don't have the teeth to stop it, then I wonder what took them so long to get that teeth, because the SEC had a long time to prepare for this. We had almost a 20-year hiatus in the market where the market was going nowhere. We should have got our laws in place. That's one side. Second thing is, yeah, I mean, some people also have the view that, look, what's wrong if you manipulate the market up? What's wrong with that? So I think that's a false notion that needs to be put to rest. Manipulation, be it up or down, is bad, because when you manipulate some share price up, it's a misallocation of resources. People are putting money into that share, whereas that share is not going to perform, and that money should go into some other company that will perform and produce economic returns to the country. So, I mean, I'm not going into a lengthy economic discussion on this, but the fact remains manipulation, be it up or down, is wrong.
Time now for a commercial break. On the other side, we have more excerpts of our exclusive interview with Ajit Fernando. Stay with us. Thanks for staying with Benchmark. We now continue with our exclusive interview with the Managing Director and CEO of Capital Alliance, Ajit Fernando. So you did say that the SEC is vested with authority to deal with this kind of situation, but look at what happened with the Director General. He was removed under controversial circumstances, or promoted, as the case may be, as they call it. And then a little after that, the chairman of the SEC resigned, saying she wants to uphold her individual principles and ethics in these situations. It is rumored that big players wanted the Director General, for instance, removed because he opposed the market manipulation that was going on and was taking action to prevent it. So if that is the case, what does this say? What is the reality of the situation?
We all hear rumors, we all hear stories in the market, but end of the day, I don't know why really the Director General moved up. I don't know that. I hear rumors, so I have to base what I say on what I know. Now, the fact is, one factor that I can say is that generally people perceive that markets should always go up. And it is perceived, sometimes with all good intentions, that anything that's done to bring a market down, or anything that's done that would result in the market coming down, is a bad thing. And this is particularly so sometimes in politicians, where they try to equate economic growth and political stability, if I may call it, with the market going up. Now, we need to be very clear, that is not the case. Markets come down even with the best of economic policies and best of political policies. Markets sometimes come down. Any policy that would change that is perceived as being how would I say, nationalist or something, which is wrong. So I think if politicians are involved in the market or involved in any of these things that happen, they should carefully look at what do we want our market to be. Do we want it to be a casino, or do we want it to perform the fundamental role it's supposed to perform? That is to bring money to people who want to invest in businesses and produce economic goods.
Why is it that the stockbrokers who met the president on the 28th of November urged the government to step up the state sector's role in the market, other than, of course, to prop it up in hard times? Now, wouldn't this mean that our stock market could end up being state-dominated, and this may not necessarily be a positive message that's going out to our investors?
First thing, I was not at that meeting and I did not participate, so I don't know what exactly was stated. But yes, you're right. I mean, there is no need for the state or anybody else to prop up the market. I don't agree with that. I think it's more important to look at why the market is coming down and to address that issue, rather than trying to prop up the market artificially using state funds or any other source of this thing. Having said that, when you say state funds, this is actually not state funds. This is Employees Provident Fund is our money. It's not state money. So there is nothing wrong with the Employees Provident Fund being involved in the market. I mean, it's good. For years we have been telling, look, get the EPF involved in the in the stock market. I don't agree with getting the EPF to come into the market to prop up the market. I think the EPF should invest in the market because the market is showing good value and to make money for the Provident Fund holders, but not to prop up the market.
So are you satisfied with the IPO front? We've seen only 30 or so of the 60 expected listings for this year, despite many planned new listings actually deferred in the wake of what was happening on the market. People's leasing went ahead despite, again, somewhat negative sentiment prevailing within the market. What does this say about it? And at the end of the day, is corporate fundraising becoming difficult?
Here again, we must remember the year before we had no IPOs, the last year we had 5, and this year we had 30. So when people say, I'm disappointed that the IPO market is not doing well, you have to be practical, you have to be realistic. You know, the market has done extremely well the last year. So we have to be extremely happy that the IPO market has done well. Now, if people were expecting 60 IPOs to come and that didn't come, I think that's a question of expectation being brought down to reality rather than reality being bad. So the last 6 months, I think we had a very tough time. It was partially driven by the fact that a lot of IPOs that came out were actually overpriced. I mean, let's not mince words, they were overpriced. So in a way, probably this correction is a good thing, because hereafter companies will not be able to do what they did previously. We have come out at massive premiums to what it's really worth, massive premiums to private placements that were held sometimes as short as 6 months before. So all those kind of crazy stuff is probably over. So it's a good breather. As I said, a market stabilizing, a market coming down a little, sometimes it's a good breather. Talking about PLC, it was not the largest IPO, it was the largest one in recent history. I mean, we had 2 IPOs that were larger than this before this. Now there it was a fundamentally sound company at very sound valuations. So the interesting thing we saw was, despite the SEC trying to be so proactive in giving small investors preference in allocation, they were not interested. So they were not interested in sound companies that had sound valuations. The reason given, and since I handled IPO, I spoke to a lot of people, they didn't think that the price could go up quickly based on somebody mopping up the excess liquidity. So the idea is the retail investors are looking for quick money.
So what does this say about our retail investor?
Unfortunately, our retail investors, and this probably is some very important factor that we need to remember, our retail investors are not really long-term investors in the market. They are more punters, they are traders. That probably is the bottom line in that sense.
What are the investment hotspots in your view?
Having just concluded the PLC roadshow in various countries, I can say Singapore is a traditional destination for all Sri Lankan money. I mean, so Hong Kong is also, it used to be the prime spots. So those two markets will always remain the hotspots for the moment. But the more interesting markets that are developing now is one market is India. India is looking very, very interesting to us because most of the funds that are managed can invest very small percentage, maybe 5 or 10% outside India. And that percentage is massive for us. So if we can just convince the Indian investors to start investing directly in Sri Lanka, that would be a big, big step up for us. Then of course Malaysia is always a very interesting destination for investment to come in from. And we need to also, in my opinion, look at the USA. While it is quite small, the amount of money that's coming, the money that's available is very large. And it is a long haul, so therefore it's tough to get people to come here. So we might have to do a lot of initial groundwork going there. So USA is definitely one of the hotspots. And of course the Middle East, there's tons of money there. Getting it is tough. We need to have channels to do it. And frankly, I don't have all the answers of how to do it. But I would say India, Middle East, USA, and the unknown wild card is China. China has a lot of money in state managed funds. If we can in some way, and particularly considering our government-to-government linkages, that would be a very interesting area to get some money from. The entire world is trying to go there. So we seem to have a very good access to that country. So I think we should look at that.
That was Arjit Fernando. We take a break now, and when we come back, we focus on the top 5 entities that grace the leaderboard of the LMD 50 for a first-hand account of what the financial year was really like for their business houses.